Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is April 8th, 2018 edition of Market Outlook. So nasty close on Friday. Markets gave up their hard-fought gains after bouncing off the 200-day moving average. So as you can see, the issue here is we failed. We did manage to hold the 200-day moving average across the board. And so that's pretty important that we do that. Now, with this sort of action here over the last couple of weeks, trying to bounce off that 200-day moving average after the decline in late March is suspect here. So there could be another down move occurring here if the market gets through this 200-day moving average and takes out the support levels that were put in here over the last couple of weeks. And so that remains to be seen. Now, the other thing is obviously we also failed the 10-day moving average as well. So we punched through it. We sort of knew that it was tenuous. Last week I pointed out that we've got this scenario where in all the four key indices, you now have declining 50-day moving averages, and the slope that is across the board. That's definitely a negative, and that's a different environment than what we've had through the numerous bounces over the last several years when the market has basically been in bull mode. So that's definitely suspect. So definite weakening across the board. Now, the thing to note is on the weekly charts, we're starting to get some important breakdowns. So if we take a look at the weekly chart here, what is breaking down is our real motion indicator. So you can see with this action over the last several weeks, the momentum here, which is measured by our real motion indicator, is definitely waning. And we know that momentum precedes price. And what I'm talking about is you can see this is some of the weakest momentum we've had, even though we're holding this 50-week moving average. So there is some important weakness in terms of momentum. And it's really first appearing in the SPY. And you can see we're starting to break down here as well on the NASDAQ 100, which was our leading index. So we really need to be rescued here with a big bounce, and then we're going to have to see what that's made of because of this now change in the structure of the market. Now, one other thing I want to note here is that our TSI indicator, which is really a very, very critical measure. When that starts to go negative in a lot of our trading models, we will not take any long signals. So look at this. The TSI is now for the first time negative. It's a minus 0.39, not very, very much. And if you take a look over here in the SPYs, we're also basically at a neutral, or we're a minus 0.55. So even though we're sort of holding up on the 200-day moving average, our trend strength indicator is showing stress already. So that's at a negative number. So right now, the Dow and the Qs are holding on sort of for dear life. So clear deterioration overall in the structure of the market, both on our trend strength indicator, showing that 2 of the 4 indices have turned negative, and that the momentum on the weekly charts is starting to roll over as well. In terms of intermarket relationships, we know the SPY versus utility, definitely important to watch and monitor, and that's one of the key components of our alpha rotation model. And as you can see here, this red here is the daily close of the ratio between the S&P and utilities, and that was over in the beginning of March. Actually, it had been under pressure, pulled its head up above, meaning that the S&P outperforming utilities risk on. But since the beginning of March, or a couple days in, we have been steadily deteriorating. And one thing to note, and I pointed it out last week, we are already in a weakened phase, right? At the moment, what we have is a weak recovery phase. In fact, for a good part of 2018, we've already been in a bear phase. And of course, you can see right here, this is the S&P hanging on for that 200-day moving average. And so what I would be doing is definitely looking at a potential short through that key level. And of course, this sideways action means that there's enough compression here that you could get a pretty meaningful move if you actually do break down through these levels. Now, moving on to some of the other key relationships, you've got a similar scenario across the board with one exception. So the S&P versus bonds, US bonds, obviously the purest safety play. And as you can see, S&P definitely showing signs of weakness there. Against high yield debt, definitely underperforming the US Treasuries, another sign of weakness. The other thing is gold outperforming spiders as well. So you can see right here on this particular part of the chart, the S&P failing under key moving averages here of that relationship, also under pressure. Now, the one exception is quite interesting, is what's happening here is wood, in this particular chart, outperforming gold. So that's telling you inflationary pressures here. So what we definitely want to do is keep track of other assets and other financial instruments that are going to be related to this stress in terms of pressure on inflation. And we'll get into more of that a little bit later. Now, in terms of looking at some of the other critical numbers we like to look at, or key stats, that is looking at institutional volume. And even though we had a couple of decent rally days, the other thing to note here is that we've got pressure in terms of volume. The market is definitely under institutional pressure. We've had 0 accumulation days over the last 2 weeks. That is about as blatant of a indicator as you can get. So as you can see, 1 month price change, we're looking at somewhere between 4 to 8%, depending on which index. Right now, the NASDAQ 100 over the last month under the most pressure with stress on Amazon, Facebook, and a lot of the leaders. And the other thing to note is, we're going to get into that a little bit more, is the pressure on semiconductors. A lot of that could be Bitcoin related, as that is now basically down in the 6,000 range in Bitcoin, which is quite a bit off the highs of when it peaked at 20,000. And that is definitely a possible factor in this pressure in NASDAQ, as a lot of the semiconductor stocks and the mining for Bitcoin could be abating. Okay, another thing on our sector summary page, look, you've got this situation right now. Look over here, you can see we've got more sectors negative, and you can see this red down here. That's a big change from this big run up here where you can see we had almost all of the sectors kicking in. If not, there were just a few defensive sectors that did not really follow the market up and remained in bearish or negative phases, which this is what this chart really indicates here. So at this point right now, again, hanging on for dear life. Sectors are showing more weakness. And when I say more weakness, let's take a look at how I'm examining that. And one of the things you can see is if you take this particular column right here, that's the 6-month change. And one of the things you can note is that we've got now more individual sectors with negative change over the last 6 months. That is definitely something to watch. Obviously, more deterioration. We've got 2 to 3 more sectors that went into a negative scenario regarding their 6-month returns. Not good. Now, the other thing to note, leading sector, semiconductors, right? For the 5 days, the last 5 trading days, down 4.6% during this period. Now, that is way underperforming the S&P 500. So the speculative sector, where hot money goes, definitely under pressure. The other thing to note, of course, is look, utilities this week, one of the stronger performing sectors. So that's definitely a defensive play. The fact is it was still down, just down less than the S&P. Risk off, definitely in gear. And actually, one thing to note is the retail sector actually was up during this period, up 0.4%. So that's an interesting sign because obviously retail being under pressure has been a big feature, certainly regarding global trade and things of that sort here in the US. So to see that stabilizing is interesting and a little bit divergent from the other themes such as semiconductors, which has been leading. So there you have it. The other thing to note is in the healthcare sector and a lot of biotech stocks. So in this particular sector, also declining quite a bit. IBB not in this particular table at the moment, but IBB also under tremendous pressure. That's purely the biotech part of the healthcare sector, and that has also been under extreme pressure. So 2 speculative sectors, semis and IBB within the healthcare sector, really having lots of pressure at the moment. Not a good sign. So finally, in terms of things to note, looking at market hotspots, what is interesting is that obviously volatility up very, very strong over the last 5 days, VXX. Now, what's interesting also is, look, in terms of other stock markets, Vietnam and Mexico actually were up and diverging from the overall markets, global stock markets, with, of course, the US under pretty much the most pressure. So there you have it. Oh, so one of the things I wanted to note here is that biotech down 5% over the last 5 days, and over the last 6 months, down 8%. So this speculative sector under pressure doesn't look like it's abating at the moment, and you're in a distribution phase. So, what's interesting again to note is some of the strongest performing instruments are related to inverse plays to a bullish market. So that's it for now. As you can see, most of the indications here is the market is under pressure. Obviously, that's across the board. You know, we looked at the key indices. Momentum definitely waning on a longer term basis. The intermarket relationships risk off, mostly in gear to say be more cognizant or prepared for sell-offs and trade accordingly. And of course, no volume to the upside on an institutional level, not good either. So you definitely have a lot of negativity across the board. The one bright spot is that we have not violated that 200-day moving average. And if we can hold there and mount an attack once again, like we had on Wednesday and Thursday, you could possibly hold this market here for a bounce at least back up to the 50-day moving average in most of the key indices. All right, that's it for now. See you next week, and good luck with your trading.